CMHC construction financing can be confusing even for the most seasoned investor. In today's video, Erin and I are going to try to explain how CMHC construction financing works and some of the intricacies around how you can use it for your next development. Hey guys, Josh and Erin back for another Finance Friday episode, and today's video we're going to be discussing CMHC construction debt. This is kind of a mystical thing that even some mortgage brokers don't really understand how to do, and it's not the most easy thing to understand. So in this video we wanted to break down why it would work, some parameters as to how you would use it, and some reasons why it might not be advantageous for your specific project.
Obviously, over the last couple of years with the emergence of high interest rates, we've seen a lot of individuals getting pushed into the CMHC financing throughout the board, but specifically today we're taking a look at construction financing. Obviously a few of the biggest and most prominent benefits of going to CMHC are a much higher loan to value in your loan to cost. I mean, you can get up to that 95% loan to cost with your MLI Select program. Much cheaper interest rates as well too throughout the actual construction term. So we're looking at prime minus versus a lot of prime plus 2.5% to 3.5% debt if you're taking a look at institutional and institutional private type lenders. So it's much cheaper to carry the project, and obviously much better takeout financing options on the back end. CMHC construction loans are convertible, so on the day or when the project is completed, your construction note converts into your term debt. You don't have to go through a separate refinancing process where you do when you're using uninsured type financing. So obviously there's a lot of benefits with going through CMHC. There are some specific requirements that you have to be able to meet, and I think in today's market, this is where we're going to start to get into some of the tricky parts and the nuances, is trying to figure out how you can navigate and how you meet those requirements. I think obviously a few of them are going to be, first off, the experience of the developer who is developing. If you guys are developing a project yourself, that experience has to be there. CMHC, specifically when they're looking at these projects, wants to see very similar history of completions to the type of project you're doing. So meaning, if you developed, townhomes, and now you're going to build some sort of like 6-7 story type project, they want experience with 5-unit or 5-story, 6-story type developments, not just single home, detached townhome type projects. Similarly, if you're building, a multi-level tower with concrete, they want to see specific development experience with concrete, not just wood frame 5-story type development. So the construction and the experience of the developer and the builder is very important when we're taking a look at CMHC, and they do scrutinize that. Personal net worth is another thing that we're going to run into. Especially, when you see things being thrown around like 95% loan to cost, and you get guys that get excited because of this, lower down payment, and they want to take on a $20 million build. Well, do you have the 2.5 or the 25%, personal net worth requirement of that loan size to, even be able to meet this on top of, your liquidity requirements getting into the project? Again, ideally 20% down just to be able to show. So it's very easy to get kind of caught up on these flashy type items. We just want to make sure the understanding is there of how this product actually works.
Yeah, the emergence of the need for this product for small to mid-sized investors wasn't really evident or didn't come into focus until the last few years, until interest rates became something that really squished the margins or stopped the margins on these projects, and these smaller projects needed to find some sort of alternative way to be able to recoup the cost of being able to get their capital back. And we've seen quite a few people start to utilize this product, and if you add in MLI Select and the increased amortization and overall increased loan to value options of being able to pull out that capital, they're really great ways to be able to push your development forward. And what we've seen is the use of these tools wasn't necessarily something that the average retail investor knew about, or the average retail investor had used. So, taking a look at how to use these tools effectively moving forward is going to be, a great way to be able to move your project along next year. What we're seeing now is that people who were initially building to sell are looking at CMHC as a viable option to be able to build and keep. So important distinction is, if you're looking to build and sell, CMHC isn't going to do your loan. They don't want you to give you the CMHC financing at prime minus and give you advantageous financing rates just to sell property for a profit. CMHC is in the business of helping people hold these assets longer term. So if you are looking to build something and keep it in your portfolio, or build it and then sell it and somebody can assume the mortgage, you're more than welcome to do that. But selling this for profit, this product isn't for you. If anybody's tried to pencil in a deal over the last 12 to 18 months, they've probably realized that the back-end financing is the limiting factor to how much capital you need to inject into a project. And this is one of the reasons why most people are moving into CMHC right now, is your takeout financing on the back end. And it's important to understand how this works. So most conventional lenders, they have a 1.2 debt servicing requirement. They have a 25, probably 30-year AM if it's a brand new build, but you're limited on the back end by the high interest rate environment we're in right now. We predominantly have mid 7, 7.2, 7.1, depending on the credit union or the bank on the takeout financing. So on the back end of your project, you're limited to how much equity you can take out of your project, which leaves a massive amount of money in a deal, which has dissuaded people from fostering development and continuing to scale their portfolio. Now, if you take a look at CMHC and how it works, if you're able to use the increased amortization, allowable loan to cost parameters, people are utilizing these products and tools to be able to allow them to get a higher takeout on the back end, which is leaving less capital in the deal, which is essentially fostering more development down the road. One of CMHC's requirements is that you actually have to take that equity takeout and you have to go and develop or build more multifamily property. And I think this is going to be a continued benefit for most investors moving forward, is because if they are incentivized or they need to take that capital out to build, we're going to see more purpose-built multifamily in the investing community.
If you're doing your underwriting at home, it's important to note that CMHC uses a completely different spec of underwriting parameters and expenses and benchmarks. I think we've talked about this before, but I've seen quite a few projects where they did their own underwriting, and it's accurate to maybe what your cost might be from your own perspective. But when we're taking a look at how CMHC underwrites these, it's a lot more aggressive and is a lot differently underwritten versus what you're going to do at home. So CMHC is taking a look at like an appliance replacement reserve cost, a certain amount of cost per elevator in the building. They're also taking a look at your utility setup, and do you have AC heat pump structures, and there's going to be a replacement cost there. There's also different types of repairs and management and maintenance costs if you're building with wood versus concrete, and then also how many units. So again, if you're sitting at home and you're taking a look at your project and you see, hey, I can afford this at 95%, I can tell you right now that there's not a lot of projects that qualify at this 95% loan to cost when we're taking a look at new builds. They just don't in today's markets. I'd say the average that we're seeing is somewhere between 70 to 85%, 85 being on the higher end, probably 75 in the middle, 75, 80. So, don't get too excited at that 95%. Send us the deal, or send your trusted mortgage advisor the file, and let's just run it through the CMHC underwritings and expenses, just to make sure that you guys have the right amount of debt allocated and whatnot moving forward. Because obviously that 95% versus the 75% on some of these large buildings is quite a big difference when it comes down to equity involvement.
Now, most CMHC lenders have different parameters internally for construction loan size. Some lenders have a minimum cutoff of $10 million, and some have a minimum cutoff of $1 million. Most larger lenders prefer to do larger loans because of the work it takes to be able to manage a construction cost or construction build overall. Now, that loan size, if you're around the $8 million to $10 million mark, most lenders will have an appetite for it. Anything under that can be a little bit dicey at times. Now, keep in mind that this doesn't outline the CMHC takeout on the back end. So CMHC takeout financing is essentially capped at around over $1 million. But your construction financing, if you're looking to get into like a $2 million project, you just may be limited by how many lenders actually have an appetite to facilitate a deal like this. So when you are looking to run your numbers for both the construction and the takeout financing, just make sure that you're on the same page, because your takeout financing lender may not be the same lender who's going to give you the financing initially to construct your project.
Another question we get a lot with CMHC financing is, because CMHC specific construction financing automatically converts into a takeout type term loan, is, can I refinance my building and take out further equity? So there's a couple kind of pieces to this question. So First off, we have to understand that when we're submitting in our pro formas to CMHC for the construction, you're typically submitting at your absolute top dollar because, why would you not? You're trying to get your building to qualify for as much loan as possible. So this means that the average deal out there, if you're submitting in at, let's say, $2 million gross rent, you're going to qualify at as much loan on your loan to cost as you can at that $2 million in rent. That's what you're submitting at. The majority of buildings out there just don't happen to, in today's market, qualify for 95% loan to cost. Again, like we stated, you're somewhere around that 75, 80% if you're on a good building. So which means if you're submitting at your top dollar rents, you can't therefore go try to refinance afterwards because you're already limited out. Now, if over the next couple of years your rent increases further and somehow your expenses drop or rates drop and you can qualify for maybe a pari passu after 12 months, you could take out a little bit of equity through that secondary mortgage. But in most cases, these purpose-built buildings don't have the ability to take out extra equity after completion, again, just due to the fact you're already submitting at your top market rents. Now there might be some exceptions, like maybe a student rental that just has insane amount of income that comes in, but these one-off type buildings aren't really the norm. So again, if you're getting that 75% loan to cost or that 80% loan to cost and you want to try to get that additional income out, you're most likely going to have to wait at least 12 to 24 months for that building to stabilize further, increase rents before you can try to take that out. But it's not going to happen right away at conversion and exit out of construction financing.
Yeah, the fundamentals around CMHC are different when you look at refinancing a purpose-built multifamily versus your takeout financing on construction. Your refinancing on purpose-built multifamily is based off of the actual value of the asset, and usually you're increasing the rents during that period to be able to pull that money out. Whereas your takeout financing on construction is really just limited to the cost of actually completing the project, the soft cost, the hard cost, the land costs, 95% of those costs. So on your takeout for construction, you have capital still in the deal. Like, you're not getting all of your investment back, but you are attaining a massive lift. Usually you're attaining a massive lift, so you have a large equity position with the actual project itself, but you're not getting all your money back. Whereas refinancing and using this tool to refinance other purpose-built multifamily, that's when you actually acquire capital and get an equity takeout back.
Yeah, I'd say like last bit of advice, when you're running your expenses, you're putting together your expenses, make sure you consult professionals in that industry. If you're taking a look at what your utility is going to be, well, if you're doing an energy efficiency type program, talk to that energy consultant. They're going to be able to let you know, based on a per door, per unit type basis, this is what your cost is going to be for you. Reach out to your insurance agent, run it by them, get a solid quote on the insurance, not just running that to similar type buildings that you have in your portfolio or maybe a friend of yours has. And this especially goes for property taxes. If you're building a 30-unit building, the 30-unit building property taxes on a new build are not going to be the same as a resale type building. They're typically drastically higher. So, consult a property tax consultant. You want to make sure that your expenses are as close as possible. A feasibility study would also be a good idea. Have a professional whose job it is to consult on these costs and these expenses to make sure you're running your numbers correctly. If you go and you buy a 30-unit building and you have $10,000 in property taxes, I can tell you that new build property is not going to be $10,000 at that same unit count. So again, we just want to make sure you're using the most amount of accurate numbers possible in your expenses and your data, to ensure that your financing is going to be as accurate as possible and you have the amount of equity needed to inject in your project.
Yeah, as many of you guys can see, CMHC is as complicated as ever, and it's not a one-size-fits-all situation. So, we are experts at doing this. We help people build, develop, construct, refinance, stabilize. We help use these products in many different types of investing strategies. So if you have any questions about how this works, each individual person and their situation is different and unique, and these products are different and unique based off of how you're looking to execute and where you're looking to execute on your plan. So feel free to reach out to Ehren and myself if you have any questions about a prospective project coming up or one that you're currently dealing with right now. Ehren and I are going to keep you up to date on all new CMHC requirements that are coming out in the new year, as well as any changes that might happen from now until then. So feel free to keep in touch with us. If you really like this video, please hit the subscribe button, hit the like button. It allows us to make more content like this for you. If you have any questions, our contact info is down below. Really appreciate it.